Hi, here we are. We're ready to look at the other side of the equation for managing a merchandise business. Now, I want you to put the other stuff out of your head right now. We're going to go through this from a periodic inventory method. Periodic method means that you don't keep track of the inventory between the beginning and the end. That means I will start with a certain amount of inventory and I will purchase inventory in the middle, but I won't show that, keep track of the inventory, and at the end I go out and count it. So let me show you how this works. First, you're going to add some new accounts. You're going to add purchases, which we've, I think, played with a little bit. We're going to add purchases and returns, purchase returns and allowances, purchase discounts, and freight in. So you're going to be working with 4 new accounts, and let's compare this to what you have been doing so you can kind of get your mind straight and free. In the perpetual inventory system, you were always putting things into inventory. Now we're going to change, and we're going to create and keep track of inventory in purchases during the period we're trying to keep track of. So if I purchase $30,000 worth of merchandise on account, that would go into purchases here and accounts payable, as compared to putting it into inventory and accounts payable. Now if I return some of that inventory, I'm going to obviously take it out of accounts payable because I don't want to pay for it. But I'm not going to take it out of inventory. I'm going to take it and put it into another account, which is called purchase returns and allowances. This kind of lets you keep track of how much you've returned. Then we're going to come down, and now we're going to pay for the purchase up here. And that's going to involve removing that return. So we paid, we started with $30,000, we subtracted $500, and we're going to multiply that times 2. That is our purchase discount. We know we have $29,500 in accounts payable that has to be removed. So that would mean that our cash is $28,910. That's what we're actually going to pay. Yeah, does that make sense? So instead of doing directly out of inventory here, we're going to put that in a purchase discount. We're going to sell inventory now. We're going to become the seller. And that's just a normal, regular way of doing it. We've got an accounts receivable for $12,500 and a sales for $12,500. What's missing in this entry from what you're used to doing, in the perpetual system, we did a cost of goods, or a cost of merchandise sold, and a merchandise inventory. You're not going to do that transaction now. So now we move on, and we've received merchandise inventory returned on account from the sale of June 18th. So one of our customers sent back some inventory that we sold. So if you come and look at this again, now we use the sales returns and accounts receivable as normal. We still don't do anything with inventory. We just, because we're going to use as sales returns and allowances in a later calculation. We purchase inventory. Now this time we're prepaying the freight. We're paying for the freight. So now we've got purchases of $15,000. I have freight of $750, and that's called freight in. And I have accounts payable down here. We come back and we've received payment on account from June 18th sales, less the sales discount. So this one, we must have had a return on it also, because it's $12,500 minus $4,000 times 1%, which gives me a sales discount of $85. I have cash that I'm going to receive then of $8,415, and of course I'm going to take it out of my accounts receivable. So that's fairly well just like we have been doing in a perpetual system. On June 29th, we received $19,600 from cash sales at a cost of merchandise sold of $13,800. Well, if I'm using the per periodic, I don't want this last part here. I'm just going to do sales of 19,000 or cash of 19,000 and sales of 19,000. So now you've gathered this information. What am I going to do with it? Well, at the end of the month, this is how this all lays out. At the beginning of the period, I know what my inventory is. It's 59,700. During the period or during the year, it could be a month, it could be 3 months, it could be however you define your period of activity, I've purchased $521,980. I have had total returns and allowances of $9,100, and I've had purchase discounts of $2,525. These two right here have to be subtracted from the merchandise or the purchases. So if I add those together, I'm going to come up with $11,625. This right here becomes my net purchases. Now what's not included in net purchases and has to be included is my freight in. So I add that in and I come up with my cost of merchandise that I've purchased. In a perpetual system, we're keeping track of this all at one time as we go along. This way we're going to do it all at the end. That means I have added this much to my previous inventory. So I had available for sale during this period of time $587,455. Now I go out and I count my inventory and I find out that I have $62,150 left. That means I've sold this much, $525,305. That is the cost of the inventory that I've sold. And that then becomes incorporated into an income statement. This pretty well, this whole calculation here, the layout, the process, is kind of a holy grail for much of accounting. So you want to remember this. You're always going to start with the beginning, what you've added to it, less what the activity on what's been added. Then you're going to look at how much you had available and subtract what's left. And that will give you the activity or the net activity or the cost of goods sold, cost of merchandise sold, cost of inventory sold, however you want to look at it. So I hope this has helped. Please be sure to get the attachment that's in the email that will lay this out for you. It'll lay out all of the transactions and the entries you'll have to make, and it will give you a template of this particular calculation or process. Have a good weekend, folks.